great. Now I get to be the teacher. It's so convenient because it's what I am. Okay, let's see what was said in chat while I missed you guys. Oh, yeah. Oh, yo, that makes sense. That's why she showed up even when I left. Okay, that's all right. We fixed it now. All right, so I'm going to go back to our course and share it. Or I'm going to just experience one difficulty after another. I apologize, you guys. I've never had this happen before. Ready to. Do you guys have to do that verification step to get in to your course? Am I muted?
Yes.
No. You do? It's annoying. Yeah, okay, here we go. Here we go. Week 2. Here we go. Here we go. Here we go. We are going. Some of these practice exercises are exactly like the homework, and some of them are exactly like your test. Okay, here's the first question. So this is going to be when you read the chapter, you read about cash and cash equivalents. Do you remember that?
Yes.
Do you remember cash and cash equivalents?
Yeah.
Okay, when you read the chapter and worked through Learn Smart, do you remember about cash and cash equivalents?
Yes.
Okay, so if you looked at a balance sheet for a company like the ones that we've looked at, you'll notice that on the balance sheet, like we're used to saying cash, but theirs will say, you know, cash and cash equivalents. And so it's important to know like what's included in cash equivalents. And there's a question on the quiz where you have to do that. God, if this will ever pull up. Should have had it pulled up ahead of time. I was in a meeting. Okay, I'm going to try going back and going back in because that's what usually works. Oops. I don't know what that background noise was, but that's what I reserve mute all for. Because all you have to do is hit your space bar to talk anyway. All right, so while that's loading, let's look at these. So the balances in the company's accounts at the First National Bank, checking and savings, are those cash? Or cash equivalents? Yes?
Yes.
Yes, they are. Undeposited customer checks of 5,200, are those cash or cash equivalents?
Yes.
Okay, so you guys are being really quiet again. So a cash equivalent is something that can be so easily converted to cash that we know exactly how much it's worth right away. Does that make sense? So much so that we could consider it an asset as liquid as cash is. Karen, are you good?
Yeah.
Okay. Catherine, I know you can't talk, but you can type. Michael, are you good?
Good.
Okay. All right. So we'll put our balance in the checking account, which is 13,500. We'll do the balance in the savings account, which is 22,100. Undeposited customer checks, do we count those?
Yes.
Yes, because we just simply have to take them to the bank. Currency and coins on hand.
Yes.
Where is that?
Letter C.
Oh, how did I miss that? Balance in a savings account. Okay, so the special thing about this savings account is that its sole purpose is to accumulate cash for a future plant expansion. So what do you think? Is that cash and cash equivalents or no?
No.
Yes.
Because
No.
you cannot use it yet.
So I think that the answer depends on whether it's actually restricted cash or not. Like if there's just a note saying they're, saving this, that's their intent, it's still cash and cash equivalents. But if it's restricted for this capital improvement, then it's not. So let's see what happens. 20,000 in a checking account at the East Bay Bank. The balance in the account represents the 20% compensating balance for a $100,000 loan with the bank. What that means is that the money that's in the bank is restricted for the loan covenants. So if it's restricted, do you think it's cash or cash equivalents?
It's
No.
not cash equivalent because it has to remain in there.
Right. Balance in the checking account. U.S. Treasury bills, 2-month maturity, totaling 15,000, and 7-month bills totaling 20,000. Do you think we use those or no?
Just the 15,000.
Just the 15,000 because that's more liquid. Okay. Let's see how we did. There we go. Okay, are you good with why everything that was the way it is?
Yes.
Okay.
Yes.
Perfect. One concept down. Okay, accounts receivable, because these are the ones that really need some work. So here's what we have. Raintree Cosmetic Company sells its products to customers on a credit basis. An adjusting entry for bad debt expense is recorded only at December 31st. The company's fiscal year end, the 2017 balance sheet disclosed the following. So at 2017, we had receivables, net of an allowance for uncollectible accounts. So that means that on the balance sheet, it would say accounts receivable, 432,000, less allowance for doubtful accounts or uncollectible accounts, 30,000. So the net would be 402. The complicated thing about bad debt expense and accounts receivable is that there's two methods for doing it. One method is you use like how much sales you had in that period. So let's say we had, $100,000 in sales, and historically we know that 5% of that won't be collectible. We'll go ahead and put on the, we'll go ahead and record bad debt expense and increase the allowance for that 10%. And that just keeps building. If we do it based on sales, we're just adding on every period, because now this period sales were there, so we're going to add it into the uncollectible accounts. If we do it based on the entire accounts receivable, like here we're looking at an aging. And with an aging schedule, we're looking at the entire accounts receivable balance. So that one is more complicated, but if you think about where you're going with them on the balance sheet, you can remember which ones to do which with. So on the balance sheet, your goal is to have your total accounts receivable balance, and then subtract from that the total amount of that receivable that you think will be uncollectible. Is that part, are we good there? We have to be good there. You have to picture that.
So you already deduct the amount that you think is not going to be collected. So you already.
Okay, so what we have is this. Here's what we have. So we have so if we look at this first question, this scenario, what we have here is we have on our balance sheet, it says accounts receivable, 432,000, less our allowance, right, for 30,000 equals 401,000, which is our net accounts receivable. Now, this is on the balance sheet. So on the balance sheet, this represents the total amount of receivables, right? Are we good here? Yes?
Yes.
Come on, communication would really help us go faster. All right, this, the less allowance on our balance sheet, this collects, this acknowledges the total estimated uncollectible account from all, right, accounts receivable. Because that's what's going to be on our balance sheet. Now, there's two ways to do this. If you do it with the sales method, which we're going to see, then we're going to take our allowance and we just keep adding on based on sales. And each year, this allowance, whatever we've added on, that's our total. Now with this method that we're looking at, when we use our, this represents total accounts receivable. So here with this method, with sales method, we're just looking at it and saying each period, as we acknowledge more sales, we're going to also acknowledge what we don't think will be collectible from each individual year. Here, we're going back and we're looking at the total accounts receivable. So when we're done, we are also going to have calculated the total uncollectible amount. So when we do our allowance account, we might have some here, but then we're going to adjust to our calculated uncollectible amount. Because on the balance sheet, these are the total accounts receivable, right? And so we have to make this, which this is what it is, the allowance amount. All right, does this make any sense so we can work it?
Yes.
Okay, here's some really weird things about this now. And there's several questions on your quiz. So the first thing we want to do is we want to prepare the summary journal entries to account for the 2018 write-offs and the collection of the receivable previously written off. Okay, so what's confusing about this is that we have our accounts receivable balance, right? So here's our accounts receivable balance. And then we have our allowance account. All right, so what's happening here? Prepare summary journal entries to account for the 2018 write-offs and the collection of the receivables previously written off. So when we write off an account, what do we do? Let's start with this. When do we recognize bad debt expense?
When you go to collection, eh?
We recognize bad debt expense each year. It's an estimate for us, right? When we estimate the allowance, what are we doing?
We're projecting how much
We're making a calculation. We're making a calculation based on historical evidence that certain amount of receivables will not be collected.
Correct. And why do we do that?
Because people are bums.
No, that's why we have to do that. But why do we do it in accounting on the balance sheet?
Because we're not bums.
Okay, the goal is,
don't overstate
Michael, I can't, you're muted, Michael, that's why I can't hear you. So what we want to do is, here's the interesting thing. So when we record the estimate, right? When we record the estimated uncollectible account, we also record bad debt expense. Why do we record bad debt expense at that point? When we do the estimate. Why do we do the estimate? When we do the estimate, how is the balance sheet affected?
It reduces the asset.
It does. It reduces the asset, accounts receivable. You're absolutely correct. So what does it do to the income statement?
You increase it.
You decrease it. You record bad debt expense. Does that make sense? When we do the estimate, we record bad debt expense. Come on, you guys, help me out by talking. Because this is a confusing concept and it's the one I need you to get. When we record the estimate, we record bad debt expense. It goes on the income statement immediately. Why do we do that? When do we record?
State the income.
We want the expense to match with the revenue that it was generated from. Because let's say we did direct write-off. What could happen is you could record the revenue for a transaction this year, and then 2 years later, you find out that you're not going to be able to collect it. And so when we find out that we're not going to be able to collect it, then we go ahead and write it off. So now 2 years prior, we recognize the revenue. 2 years later, when we wrote it off, we recognize the expense. So those aren't in the same period. So the purpose of estimating uncollectible accounts is that we record the bad debt expense in the same period as the revenue. Okay, so we know that we have some information here. We know credit sales. Are $1,750,000. We know that we collected cash of $1,830,000, and there's $35,000 in accounts receivable that were written off. We also had a $3,000 that was collected from a customer whose account was written off. Okay, so here's the interesting things about this. So the first thing that we're going to do is do the journal entries for the 2018 write-offs. So so here's the thing. You have to figure out where we're starting from with this. So where we're starting from with this to do the write-off, the first thing that we did was we had originally recognized bad debt expense. And recorded our allowance for uncollectible accounts, right? This is where we were before. Pictures. Great, can't move the pictures right now. So we recorded bad debt expense for however much and allowance for uncollectible accounts. So have we recorded the bad debt expense already?
No, not yet.
Can you see my screen?
Yes, I will see it.
Can you see my screen?
Yes, I can see it.
Okay, so the first thing we did for here where we're saying, and 35,000 in accounts receivable were written off before we get to that, right? We don't write off a specific receivable in the beginning. Instead, what we do is we make an allowance for what won't be collectible. When we make this allowance for what won't be collectible, we recorded bad debt expense. So when we now identify an account that we're going to write off, do we recognize bad debt expense then?
Yes.
No, you already recognize it.
Well, if we've already recognized, since we've already recognized bad debt expense, when we made the allowance, when we write off an account, it's kind of like, oh, and that was part of what we put in the allowance. Does that make sense? So,
Okay, yeah.
so this 35,000 that we're now going to write off, we look at that as, oh, that's part of what we already identified in our allowance. So when we write something off, we're going to do something very interesting. We've already recorded bad debt expense. So what we're going to do now to write something off is we're going to decrease the allowance for uncollectible accounts and put it back into a yeah. All right, so what we're going to do here is we're going to say, for requirement 1, we want to record the accounts receivable that was written off during the year. So we wrote off 35,000, right? We wrote off 35,000. So instead of recording bad debt expense, because we already did that when we recorded the allowance, we're going to reverse what we just did. We're going to say, okay, we're going to take it out of the allowance account and we're going to take it out, yes, we're going to take it, yes, Catherine, we're going to take it out of accounts receivable. And you can remember that because we take it out of the allowance account because it's like, oh, there's one of the ones that we put in the allowance account. Now we identified it. And we have to take it out of accounts receivable when we write it off, because if we don't, we'll still be trying to collect it. Does that make sense? You guys really have to talk to me about this because I need you to understand it when we're done. I cannot bite you or throw anything through the computer, no matter how much I want to.
Good try. I like that.
Okay, so now when we go to reinstate it, what you need to know, what you need to see to understand how this is working is, so what happened was we went and we wrote off the account. So we reversed the uncollectible account. Took it out of that, and we took it out of accounts receivable. So we have to remember that that's what we did. That's where we stand right now. So is it in accounts receivable? No. And it's not in the uncollectible account either. By the way, here's the other interesting thing. When we write off an account, our net accounts receivable balance does not change. And here's why. So on our balance sheet, right, we have accounts receivable less our allowance. So right now, our accounts receivable, let's just say it's 100,000. And let's say our allowance was 20,000. So our net receivable is 80,000, right? Now, let's say that I did $10,000 here to make the numbers easy. Let's say we've written off $10,000. Okay, we know that we take it out of the uncollectible accounts and out of accounts receivable. So accounts receivable is going to become 90,000. And the uncollectible accounts minus 10 is going to become 10,000. So my net is still 80,000. So when I write off a specific account, my net accounts receivable does not change. Thoughts there? God, you guys have to talk to me. I don't know what you're thinking if you don't talk.
Trying to
I had
process.
kids before I got into the clairvoyance class, and I was just overwhelmed and didn't pay enough attention, I guess.
I'm so sorry, Professor. I would love to talk more.
That's okay, Catherine. You have an excuse. Okay, you
What about
understand.
me? I got an excuse too.
You do? What's your
Yeah.
excuse?
Okay,
um,
let me get focused.
okay, so now what we're going to do is to reinstate an account previously written off, we are going to simply, and we only have 3,000 that we wrote off. So we're going to reinstate. Right, exactly. So we have to put it back into accounts receivable, because if we're reinstating it so that we can collect it, we have to put it back into accounts receivable or we can't collect it. And we're going to take it out of our uncollectible account. So put it back in. So basically what we're doing is simply reversing the entry that we did when we wrote it off. So now it's back in accounts receivable and it's back in the allowance. So we're right where we started from. Now we're going to collect the money. How much are we going to collect? We're going to collect the whole 3,000. So we reinstated it so that we could collect it. Now at this point, you're doing exactly what you would normally do when you collect a receivable. So what is that entry? Yep, you got it, Catherine. Cash, because we received cash, and now we're going to get rid of the accounts receivable because they paid us. Oh. No, I'm not. Why can't I not record the entry? Did I already record it? Let's see. Cash accounts. Okay, I did. All right, so let's look at the next one. There we go. Wait, are we done? Oh, we are done. Okay, so now we're going to do now we're going to estimate bad debt expense. So bad debt expense is estimated to be 3% of the credit sales for the year. So how much were our credit sales for the year? So, okay, so here's what we have with this. Yeah, it's a little bit more than that. So we want to know, we're going to record what's the next thing we record? Oh, the bad debt expense. Okay, so what we're going to do is we're going to say credit sales were $1,750,000. What percent are we not collecting? We're estimating it at what percent? Where's the percent?
The bad expense is estimate to be
Yeah, we'll get there in just a minute.
3%.
It is 3%, right? So 1,750,000 times 3% gives us 52,500. Yes. So this is what we think will be uncollectible from our current sales. All right, so we started with accounts receivable of 432,000. Right? We added $1,750,000 to sales. And then we collected $1,830,000. And we wrote off $35,000. and we collected,
3,000.
I think I have to do the collection too.
Yeah.
Actually, 432, 1750, 35. No, I don't, because it was already in there. So our net receivable balance right now is 347,000 is our balance in accounts receivable. Does that make sense? Do you see how I got that?
What about the $30,000 and collectible? It doesn't apply here. The one.
It's already in the account. We're going to deal with it in just a minute.
Okay. Sure.
All right, so the next thing we're going to do is we're going to do our journal entry for bad debt expense, which we said bad debt expense, 3% of credit sales for the year. That's the one we figured out was 52,500. We took the credit sales times 3%. We're going to record bad debt expense, which goes where? What financial statement are you going to find bad debt expense on?
Expenses?
Which financial statement?
Oh, no. Income.
Yes. And our allowance, 52,500. Okay, so when we're doing this based on sales, we keep adding on to the allowance account. All right, bad debt expense is estimated by computing net realizable value of the receivables. The allowance for uncollectible accounts is estimated to be 10% of the year-end balances. Okay, this is where we're going to go back and we're going to look at, we did 52,500. Estimated by computing net realizable value, 52,500. Seriously. I just used a calculator for that. So how am I going to figure out, I have my aging schedule, bad debt expenses estimated computing net realizable value of the receivables. The allowance for uncollectible accounts is estimated to be 10% of the year-end balance in accounts receivable. Okay, so we just computed the year-end balance. Yeah, we just computed it. Where did I write it down? Because I just computed it on the screen.
You're gone.
347,000. So the way we got that, yeah, 36,700. So the way we got the amount is we're saying we have our beginning balance of 30,000. We're going to add collections. Which we collected 3,000. We wrote off 35,000. We had I should have done this with the T account. I think I want to do it with the T account. So if we look at it with the T account, we have our allowance, because this is what you're really going to have to be able to do. So from our allowance account, we had a beginning balance of $30,000. We added $3,000. We collected, so took out of it, $35,000. So now we have a debit balance of $2,000. Then we have our new allowance, which is $34,700. And if we add all of those up, we end up with $36,700. And that's going to be our allowance balance. So because we're doing it based on total receivables, that's going to be our amount. When we do it based on total receivables, you adjust the allowance account to get your bad debt expense. Okay, so we're going to go back and use $36,700. So we're going to go down here and we'll do bad debt expense. We're just doing it in a different way. By the way, you wouldn't use both for the same company. We're just looking at different ways of doing it. And then our allowance for uncollectible accounts. Debit bad, yes, debit bad debt, credit allowance. I'm glad you love T accounts. It's one of the reasons we like this book. I don't like doing accounts receivable without them anyway. Okay. Now, bad debt expense is estimated by computing net realizable value of the receivables. The allowance for uncollectible accounts is determined by an aging of accounts receivable. Problem is, bad debt expenses estimated. The problem is they're not telling us what's more overdone. Yeah. So they're not telling us the balance in the allowance account. I mean, am I missing something? Because they give it to me later.
You got.
Yeah, because there's like no, we have to know the amounts in this group, in this group, in this group, in this group. I can tell you what, for some reason, I'm not seeing them here, but I don't know what's wrong with this. This was, oh, I see what we're doing. So accounts receivable at the end of the period was, total accounts receivable is 347,000. So 347,000 times 65% gives us 225,500 in the 0 to 60 days category. The 61 to 90 days category is 347,000 times 20%. How much is that?
$69,400.
69,400. The next one was kind of obvious. So the next category is 10%, and that's 34,700. And then the last category is 17,350. Okay, so this is, stop it. So this is 17,350. All right, so this will all add up to 347,000, right? That's how our numbers came from. So now what we're going to do is we're going to figure out how much is each one of these to get a total uncollectible account. The idea behind an aging schedule is that the longer an amount is outstanding, the more likely it will be to be not collected. So the 0 to 60 days starts out at like 4%, and the over 120 days, we're saying, yeah, that's probably 40% not collectible. So 225,500 times 4% is 9,022. And then 69,400 times 15% is 10,410. And then the next one's 8,675 and 6,940. And so the total based on the aging would be 35,047. So now the question is, first of all, am I going to adjust my allowance account, or am I going to, for bad debt expense, or am I going to just add on? Yes. Am I going to adjust the allowance account or just add on?
Wouldn't we want to adjust it?
Yes, we would want to adjust it because we're looking at the total allowance balance. So now what we want to know is if our original balance in our uncollected, so 35,047. Okay, so now we want to know 37,047. Yes, it should be. Jake, go lay down. No, it's yeah, 37,047. So what do we do with that? This 37,047 is our bad debt expense. Just ruin my tablecloth. For 37,047, and we're going to put it into our allowance account. 37,047. Now on our balance sheet, our bad debt expense will be 37,047, and our allowance account will be whatever, our bad debt expense will be whatever the total should be, and our allowance account will be adjusted to the balance 37,047. Did it record? Yes, it did. That was it for number 3. Requirement 3. Net accounts receivable reported. Okay, so for the way we did it in the first one, we had accounts receivable of 347,000, and we had our uncollectible account. So number 1, we'll do A. For A, we started out with our accounts receivable at 347,000, right? Remember that number? And our allowance account started out with a balance of 52,500. and we adjusted out 2,000. So our total allowance is what? Oh, really? 5,000, 50,500. Remember that number? Okay, you can review it. So our net accounts receivable means the 347,000 minus the 50,500 for the allowance gives us a net receivable of what? Really, you guys? Okay. 296,500. So that's going to go in A. Now for B, let's look because we did that a little bit differently. So for B, we had our accounts receivable balance, and that was still the 347,000, doesn't change. And for our uncollectible accounts, we had 34,700. And there was no adjustment because we did it based on the total receivables. So we have 347,000 minus 34,700 gives us 320. You know what? I'm going to have you guys work in groups next week. Then you have to participate. 312,300. And with C, it's the same thing. For C, we have our 347,000 for accounts receivable. And we calculated the allowance of 35,047. So for C, we're at 311,953. Now, I want to point something out because look at these amounts. So we have 296, 312,3, 311,953. Are any of those the same?
No.
No.
Yeah.
And yet, they're all an estimate of uncollectible accounts for the same period. So because it's an estimate, based on the way we do it, it can end up different amounts because it's an estimate. So we'll put in here our 296,500. Well, we'll try to type all the numbers. We'll put in here our 312,300, and we'll put in here our 311,953. And we'll see if we're correct. Because it was a long problem. I don't want to repeat it. Yay! Green X's, I love them. All right, are you reasonably good here?
Yes.
Yes.
All right, so that's good because these are the ones that usually trip people up. Okay, so now this is looking at discounts. And there's two ways to handle a discount. When you offer a discount when you're selling, there's the net method and there's the gross method. So with the net method, you figure out the discount. With the net method, you don't do the discount. You do the complete amount of the sale and you take, net paycheck, gross paycheck. I'm tired. Right. So one method, we're going to simply record the sale as though they're not going to take the discount. And then if they take the discount, we'll record that they took the discount when we record the money that we receive. With the other method, we're going to assume that they will take the discount. So when we record the sale in the accounts receivable, we deduct the discount from it off the top because we're assuming that they're going to take it. That make sense?
Yes.
Sort of? Yes? No? Maybe?
Yes.
Yes.
Yay! Okay, so our first journal entry, record the sale of 100 units with a list price of 600, a 30% trade discount if applicable, with terms 210 net 30 under the gross method. So does gross mean I include it all at the beginning or that I wait? Wait. Okay. So we're going to say, we're going to look at this and we'll calculate what it's going to be. So, well, this is not hard actually. If we're going to wait, 100 units with a list price of 600. So
6,000?
yeah. 60,000?
Oh, yes.
Okay. I thought it was me. I'm still getting over my concussion. 60,000. Sales revenue. Accounts receivable. And then sales revenue will be the same thing.
How about the trade discount of 30%?
You gotta record it first, isn't it?
Yeah, well, that's why I asked you first, gross or net. When it's gross, do we deduct it? Or when it's net, do we deduct it first?
Net is deduct first.
Net,
and gross
net
is
you
later.
deduct it first.
Right, and gross is not. So we're doing gross right now. Sales revenue, there we go. I had to hunt for that one. Wait, how did I get the 60,000 wrong?
Because I think the book, I answered it, it deducted the 30% already, so it's 42,000.
So with, okay, so we had them backwards then.
Yeah.
Gross you deduct and
Okay, so here, we're looking at this and we're gonna say, we have 300, what was it, 600?
600 times
What was the amount? 600 times what?
100.
60,000.
So we have six, yeah, okay, so we have 600 times 100.
And give you 600. And then we get that 30%. That thing is
Right, which is 60,000. And we're going to assume that they're going to take the discount. So, and it's a 30% discount. So I'm going to figure we're going to collect 70%. So we're going to collect 42,000. Is that right? Did I add that right? Okay, so now we'll switch this to 42,000. What is that? Oh. Wait, where'd the entry go? Okay, it's there.
oh, you got it right.
I know, right? Okay, so requirement 2, we're going to do the opposite. So in requirement 2, we're going to record the sale, same situation, but this time we're not going to deduct the discount. We're not going to assume that they're going to take the discount. So now when we do this one, it's going to be accounts receivable and sales revenue. Oh, that was easier. For what was the total amount we calculated? 60,
60,000.
Okay, so group. What am I doing? And collection on December 15th, assuming the gross method of accounting. Oh, it did the same one.
Right.
I think in one, you already did that, innit?
Oh yeah,
That's why you did a
no,
one.
this is gross also.
You
Wait,
use 42,000 as the base, and then you
And then,
the 10%, or I mean.
oh, and collection on December 15th.
yes. Now
So
you
this was record the sale, and this is the collection. I'm just not paying attention. No, it says record the sale under the gross method. So how is this different than the, oh, that is the first one. Oh, wait, what happened? I changed this number. Did I go back and change it to the wrong number? I did. I didn't have my screen switch. What was it, 42,000? It wasn't even,
Yes, it was
42,000.
42,000.
I must have fallen on my head again. Record the cash collections on December 15th. Okay, so here's the thing. Now we go back and we look, December 15th. On November 17th, we made the sale. We get a 2% discount if we pay within the discount period. And we've already assumed that they're going to take the discount. So now the question is, do they take it? So they pay us on December 15th. Do they get the discount? Yes. Yep. So now all we have to do is reduce accounts receivable and record cash. Because we already figured they were going to take the discount, which they did. And so we don't have to do anything with the discount.
So can you hear me now?
Yes.
So the 30% is the trade discount, so they get that either way. Then the sales discount needs to be accounted for now.
What isn't complete?
Okay.
No. So
there's a part 2 to Rec 1.
Professor, I had this problem with the book too. Every time I was checking my work, it was popping me back and forth on requirement 1 and 2 and not recording both of them. It took a couple of times.
it's not just me. I'm like, this isn't working. So the discount, yes, they get a 30% discount if they get a 30% discount if they pay within the discount period. So
No, it's a 30% trade discount, and if they pay during the period, they're gonna get 2%.
2%.
On top, I mean, after the 30% trade.
That's the problem. That's exactly the problem. Well, no, there is no problem. Except for why does it still say it's not complete? What am I missing?
On Rec 1, there's 2 portions. You have to return the question and go back to Rec 1. No, and then go to, yeah.
There we go. Collecting. Record the cash collection. Oh, so record the cash collections on November 26th. They bought it on November 17th. So do they get the discount?
Yes, they're gonna have a 2% discount on the 42,000.
Right, a 2% discount on the 42,000. So what we're going to do here is we're going to say, so they have 42,000 that they owe us, right? 2% discount. So we're going to collect times 0.98, 41,160. What's the difference going to be between the 41,160 and the 42,000?
840.
But what's it called?
Sales discount.
Sales discount. Okay, so 41,160 and 840.
41.
Yes. Okay, so we're going to collect, what did I say we were going to collect? Cash. 41,160. Thank you. 41,600.
41,160.
Thank you. And we're going to eliminate.
Sales discounts.
Yep, we're going to record the sales discount. Of 840. And then we're going to reduce the entire accounts receivable balance, which was
42,000.
42,000. Because we have to look, you have to think about what's on your books and you have to make sure that the entire 42,000 is gone. And it's complete. Okay, so this is under the net method. Okay, so under the net method, we're still going to say we have accounts receivable of 60,000, right? And allowance no, sales revenue. Okay, I'm confused because we just did the gross method.
Should we be taking that 30%
You
trade
guys gotta take
discount?
the 30% on it.
That it should actually deduct everything already, so it was 41,160.
That's what we
Because
just did.
when they pay their terms are 2% 10 net 30, so that 30.
We just did, but we're recording the sale. But we just did the net method. We can't do it this way for both of them. Okay.
Well, isn't it for the first one, we just took the trade discount, but our base was 42,000, and then our discount was 41,160, and then for the net, we discount everything, assuming that you're gonna take.
Oh yeah, the trade discount also. Okay. So we're gonna say we have 600 times 100 equals 60,000 in sales. Now, 60,000, we know right off the top they're going to get a 30% discount, which means that we're going to take 70% of this.
Oh, okay.
Because that's what we're going to collect. The 30% we won't collect. So we're going to record the 70%. So when this is done, they're going to owe us $42,000. If they take a 2% discount, we're going to collect 98% of this. So we're going to collect $41,160, which should seem familiar from just right before. But now we'll do accounts receivable, $41,160. And 41,160.
Sales revenue.
Yeah, so we've recorded the sale, and with the sale, we took all the discounts conceivable. So now we're going to record collecting the amount. So we put down accounts receivable, $41,160. They collected it within the due date period on December 5th. Wait, they collected on December 15th? No, that's within the discount period because we had November 17th. You missed one on 3A. Oh, thank you. Okay, you guys are gonna have to add up. My phone just died. I'll plug it in and just, good God, we have to take a break. I'll plug it in just a minute. I know. So on number 2, now we're collecting it. So we're collecting it, but we recorded 41,160. So we're going to collect cash for 41,160, and we don't have to do anything with discounts. We can simply deduct straight from accounts receivable 41,160 because that's what we have in our receivable balance. Does that make sense?
Yeah.
Yeah, it makes sense.
So now, let's go look at 3B. Okay, so now record the sale of 100 units with a 30% trade discount with turn 210 net 30 under the net method. So we're going to do exactly the same thing. So we'll just accounts receivable and sales revenue 41,160. Accounts receivable, sales revenue. Now for B, we record the cash collection on December 15th. Okay, so when did they? November 17th, so they still take the discount? No. If they, that's what I was expecting, but if they sold it on November 17th and collected on December 15th, oh, they didn't pay within 10, 17, 18, 19.
10 days.
Right, 10 days. Okay, so they're gonna forfeit it. So now the problem is we've recorded this net. So when they forfeit it, we have to record that they forfeited the discount. And we do that because they're not gonna pay us 41,160. Because when they look at their own records, which is what they're going by, when they look at their own records, what they have is accounts receivable of 60,000. Does that make sense? On their records, on our records, we recorded it net. But on their records, they most likely recorded it, that we have an accounts receivable amount of 60,000. We recorded, oh, they still got the trade discount, I see, less the trade discount, so 0.70. So we have that they owe us, what's 60,000 times 0.70? 42.5?
42,000.
42.
42,000. So that's what we have that's what they would have that they owe us. Now we recorded 41,600, but we need to collect 42,000 because they missed the discount. So we have right now in accounts receivable 41,160. What do we have to have when we're done in accounts receivable?
42,000.
No, none, because they're paying us.
Oh, okay.
So right now, when we recorded our entry, we recorded 41,160 in accounts receivable. Once we get paid, we're not going to have anything in accounts receivable. So we have to reduce accounts receivable 41,160. Does that part make sense?
Yes.
Okay, now let's look at what cash we're going to collect. So the cash that we're going to collect is going to be 42,000 because they don't get to take any discount. So now if we collect 42,000 cash and we're recording that we're writing off accounts receivable of 41,160. The difference is, somebody had calculated it.
840.
840.
Mm-hmm.
And this is the discount that was forfeited because they didn't pay within the due date. Now, if we had recorded it under the gross method, we wouldn't have recorded it without the discount. So we would simply not have to do anything, just simply do it the way we've always done it. But in this case, because we did not, because we took out the discount to begin with, and now they've missed it, and they're not taking the discount, now we have to record that. So we're going to reduce accounts receivable for the 41,160. We're going to receive cash.
42,000.
Thank you. 42,000. So I have my forfeited sales discount of, what did we say, 800 and what?
40.
840. And did I do both? I did both. It's the correct and complete. All right, does gross and net make sense?
Yes.
Okay, we've done this. I want to look at, how are you guys with bank reconciliations?
Mm-hmm. It's all right.
Okay, so the whole thing about a bank reconciliation is that it's looking at timing differences. And I know that some of you are thinking, well, we don't do this anymore, but all businesses still do them. So what you're looking at is the whole thing is looking at timing. That's all. So we have our bank balance and we have our book balance. And here's some of the common items. So let's say that we have a customer come in at the end of the day and they give us a $3,000 deposit to make. And let's say it's the last day of the month. So are we going to put it in the bank?
It depends if it's a day or it's the end of the day.
Well, if it's the end of the day and you're owning a business, you're going to take that with you to the bank. So when we record receipt in our accounting system and plan to take it to the bank, are we going to increase the cash on our books?
Yes.
Yes, we're going to increase the cash on our books. But will it be on the bank statement yet because it's at the end of the last day of the month?
No.
No, it's not. So for timing, we're going to have to add to the bank deposits in transit, which is what that's called. Now, let's say that at the last day of the month we wrote payables checks. Are all of those checks going to clear the bank?
No.
No. But will they be deducted from our book balance?
Yes.
Yes. So we have to subtract outstanding checks. These are the main things. What you're going to see with the bank, what you're going to see with the books are subtracting service fees, adding note collections, like if they collect notes for us. Subtracting NSF checks are common examples, and then errors. And errors can go either direction. Errors are confusing because they can add or subtract. Okay.
Don't you also have interest sometimes?
Yeah, interest is another common one. Used to be a lot more common than it is now. Okay, so those are all things you're going to adjust the banks for. When you're all done with your bank reconciliation, we have to do journal entries for one of these two items, either the bank or the books. Which one do you think we do journal entries for?
Books.
Books.
Right, because doing it for the bank wouldn't make any difference. The only thing we can impact with journal entries is our books. So we're going to do journal entries for our books. Okay, so let's look at this. Bank balance to corrected balance. So we start with on the top the bank balance and the bottom the book balance. It doesn't matter which direction you do it in. So we know that here's our balance. This is the bank statement. Okay, so our balance at the end of the month is $38,018. So I'm going to put that right here, $38,018. Feel good about that?
Mm-hmm.
Okay, and now we need our cash balance. So our general ledger had a balance of $38,918. $38,918. All right, so now we have our starting points. Deposits outstanding totaled $6,300. And all checks written by the company were processed by the bank except for those. Okay, so deposits outstanding were $6,300. Are those deposits recorded on our books? If we get a deposit, do we record it?
Yes.
Yes.
Yes. But does the bank record it immediately?
No.
No. So it's recorded on our books. We have to add it to the bank to make them the same. So we're going to add deposits for $6,300 because they're on our books, they're not on the bank. And all checks written by the company were processed by the bank except for those totaling $84.20. So we have $84.20 in checks that we have deducted from our bank balance, our book balance, but the bank hasn't done anything with yet. Do I need to add or subtract those outstanding checks from the bank balance?
Add.
Add. No, they're outstanding checks. They're not an outstanding deposit.
Our
Yeah.
check?
Are you
What?
subtract?
Subtract.
Right. because they're checks. We've subtracted them from our book balance. We now need to subtract them from the bank balance. Add checks outstanding. I don't think so.
Less.
Yeah, I'm like, I'm not adding those. In addition, a $2,000 July deposit from a credit customer was recorded as $200 to cash and credit to accounts receivable. And a check correctly recorded by the company as a $30 disbursement was incorrectly processed by the bank. All right, so let's start with the beginning. $2,000 July deposit from a credit customer was recorded as a $200 debit to cash and a credit to accounts receivable. So the bank probably recorded it correctly. But we have $2,000 deposit. And on our books, we recorded it as 200. So we need to add
add the error.
1,500 more. Does that make sense?
Yes.
Yes.
So we're going to add 1,800 to our books or the bank balance.
Book.
Books.
Right. The books are wrong. So we're going to add.
In recording, cash receipt.
Error. Okay. And a check correctly recorded by the company as a $30 disbursement was incorrectly processed by the bank as $300. So if we had a $300 disbursement and it should have been 30, that means that the bank deducted $270 too much, right? So are we going to correct the bank or the books?
Bank.
The bank. So I need to, they deducted, so I need to add back 270. And it's an error on recording a disbursement. Cash receipt, cash disbursement. There, bank error and recording check. Okay. We're done with that. So let's see what else is here. So deposits, we dealt with the deposits in transit. The checks we dealt with the outstanding checks. Service charge, $30. That shows up on our bank statement, but have we done anything with it on our books?
No.
No. So we're going to record the service charge for $30. But we're not going to add a service charge. We're going to subtract a service charge. There. Oh, I wonder if I need to put this minus 30, minus 8240.
No,
I don't. It knows. Okay, good. All right, so we have the service charge. NSF check. So that means that if there's an NSF check, it means that on our books, we recorded that as a deposit, right? And according to the bank, they've deducted the money from our account because it's a bad check. So do I need to correct the bank or the books?
Books.
The books.
The books.
And do I need to add or subtract that $1,200?
Subtract.
Subtract.
Subtract. Monthly loan payment deducted directly from our bank account includes $320 interest, which doesn't matter until we do the journal entries. So they deducted our note payment, $33.20. Do I need to adjust the bank or the book?
Books.
Books,
The books.
less the loan payment. And that's it, because we're done. So would somebody please add up the top, and would somebody please add up the bottom?
I'll do the top.
36,168.
What's the top? 36,168. The bottom better be the same.
We see it.
Because if it's not, we made a mistake.
It doesn't look like it's the same.
I don't know.
45,268. So
You gotta subtract 1,230 out of that. Out of 30.
Well, we know the amount's right because it is up there, 36,168. I just cheated.
Okay.
Because if the top's right, the bottom balance has to be right. If all the other numbers are right.
You gotta take 4,000.
Okay, so now
5,000.
less bank error in recording check. So that was
Add.
It's the disbursement, that's why.
Add bank error in recording check.
Who did that? Add bank error in recording check. Okay. All right, now requirement 2, we're going to do the journal entries, but only for the book. So the first journal entry, record the transaction to correct the error in recording the cash receipt from the credit customer. So the error for recording the cash receipt, the 1,800. So the 1,800, in addition, a $2,000 July deposit from a credit customer was recorded as $2,000 debit to cash. So it should have been a increase in cash and a reduction in accounts receivable because it was a collection from a customer. So we're going to increase cash by 1,800, and we're going to decrease accounts receivable by 1,800. Does that make sense?
Yes.
You think?
Yep.
Next journal entry. Hopefully they give us information so I don't have to backtrack. Nope. Record the credits to cash revealed by the bank reconciliation. Use a miscellaneous expense account to record the bank service charge. Okay, so record the credits to cash revealed by the bank reconciliation. So credits to cash, service charge, NSF checks, and loan. Okay, so let's do the service charge, NSF, and loan. So we're going to take service charge, reduces cash. So service, wait, what did they say to put? Use a miscellaneous expense account.
Expensive.
Ew.
That's a new account, isn't it?
Ew, I hate miscellaneous expense. $30, right? And then we're going to record the NSF check. So what creates an NSF check normally? A customer pays us, right?
And the check bounces.
And they
And the
check
check
it
bounce.
got rejected.
So we have to put it back into accounts receivable. Do you remember what the amount was?
1,200.
1,200.
1,200.
1,200. If it's wrong, we'll double check. Oh. And then what was the other one? NSF check. No, that's not. What was the note? How much was the note?
3,000.
3,000. So now we have the note. Oh, the note's more complicated.
Yeah, it's interest expenses.
Yeah, because on the note we have, they collected, oh, 300, so they collected a $3,000 note and we have interest expense of 320. So we can go right over here and we can record interest expense of 320. Oh, good. I don't have to put that in miscellaneous. And then we reduced a liability, right? So we're going to reduce the note payable. For 3,000. And we're going to reduce cash for all of these. So 4,200, 3,450. So three, four, five, 2, 3, 4, 5, 3, 4. Did I do that right? Oh, let's see.
It's trying to get the total.
Yeah, my calculator died.
Okay.
Guess I should have plugged my phone in when I got home.
1,200.
Yay! Okay, so now I'm going to stop sharing this, okay? And I'm going to instead share our PowerPoint. I'm sorry, we didn't take a break. I don't know what my problem is. I know what my problem's gonna be. It's gonna be my daughter. Here we go. And I'll post this to our class, of course. I'm gonna tell you very clearly where you need to look and review. Okay, so quiz 2 review. Looks really simple here. You have to be able to tell me the advantages of the multi-step income statement. What do you think the advantages are of the multi-step income statement?
Well, detail.
Right, it gives you more detailed information. You have to know how to calculate gross profit, sales minus cost of goods sold. Gives you gross profit. Are you good there? So far, so good. You have to know. You have to know why we separate operating income from other revenues and expenses. And we talked about that on Tuesday when we did that part of the work. You have to know the categories that require earnings per share calculations. For instance, you do it on net income, you do it on, you haven't gotten into this yet, but there's times when you would estimate like anything that might dilute it and do it. You have to do it a separate calculation for unusual or infrequent items. You do not do a separate calculation from operating income. You go ahead and go straight down and just do net income. You do not do a separate calculation for income from operations. Does anybody know why I just repeated that twice?
No.
You want to guess?
Because it's on the quiz.
I'm not
Because
good
it's on the
guesser.
quiz. Thank you. Yes.
Oh.
Components of you have to know the components of cash flow from operating, investing, and financing. And you're quizzed on that in 2 ways. One way is multiple choice questions where you're asked to identify like which item is not in like operating, or which item is not in investing. Or you might be asked which one of these is an investing activity. And then the other way that you're tested is you're given a group of, transactions, and you have to add up like what would be from operations, or what would be from investing, or what would be from financing. So you're going to get hit hard on the cash flow statement. You want to know what are those categories and what goes in them. You have to calculate income tax and know where to report it on the income statement. So you can look at examples in your book. You can look at the examples we worked on Tuesday. All right, are you okay with all of those so far?
Probably the bank bank reconciliation.
Yep, and the bank reconciliation,
Gonna work
which
on
we
that.
just did.
Mm-hmm.
All right, anything on this page that you're looking at and just going, oh my God, did we cover that? Okay, you guys, now's a good time to speak up.
Oh, the income tax, we did cover it, right?
On Tuesday.
Okay.
So you get down to the net income before taxes, you multiply that by the tax rate, and then you subtract income tax.
Okay.
And look back to see where it is on the income statement. Okay, and also if you look at any of these and you're thinking tomorrow or Saturday, it's like, God, I thought I understood this, but I just don't. You can call me, we can go over it. I'm gone in the middle of the day on Saturday, and I'm gone in the middle of the day or the late afternoon on Sunday. But other than that, I'll be around. And frankly, I'll have my computer with me for my daughter's tryouts when I'm at the rink in the middle of the day tomorrow. Okay, second page. You have to be able to calculate income from continuing operations. We did that. You have a problem like that in your homework, and you had a problem like that in the practice stuff for on Tuesday that we did. You have to know how to prepare a multi-step income statement, and it is exactly like the first homework problem. And you have to actually prepare one. Like the first homework problem is on the test. You have to prepare a single step income statement. We did that on Tuesday also. That is on the test, preparing one. You have to prepare a statement of comprehensive income. That was like the first question that we did on the chat problems. You have to prepare one on the test. All right, are you okay with those?
Yes.
And
Yep.
if you get into it and you're not, you could call me. You have to be able to do the gross method for discounts, which we just did, the gross and the net method. Given the fact that it says gross method here, you don't have to know, the net method isn't on there apparently. You have to be able to do the accounts receivable write-offs, reinstatement for collection, and then the collection. Exactly like the journal entries we did at the beginning today. You have to be able to calculate the allowance for uncollectible accounts and bad debt expense. And you have to be able to do a journal entry for a sale with the discount using the net method. Okay, so there's gross and net. So you have to know gross and net, just exactly like we did today. Okay, how do you feel about this?
Good.
Have I twisted your brain into a pretzel, or are you feeling okay?
It twists mine.
Okay. Catherine, what time zone are you in? Oh, that's Central. Yeah, I guess 10. You can be tired. It's 11 for me. I'm really tired. Oh, well, okay. There you go. You don't sound like you should be working 13 hours. Oh, end of the month. Gotcha. That explains why you're working when you clearly don't feel well. Or maybe you feel okay and have no voice. I've had that happen too. Okay, call me if you have questions.
I will call you, definitely.
Don't forget, if you haven't already done it, that there's a discussion this week for me to approve your paper. Oh. Catherine, have you gotten a prescription from the doctor? Okay. Just want to make sure it wasn't one of those times when you're sick, but you can't go to the doctor because you're too busy at work, which it's really hard to do because you're sick. I've been there. Can you tell? I'm still there. I'm vertical and all good. Oh yeah, I know. And it doesn't get, yeah, and it doesn't get better. It's like I used to always be sick after final exams because you just get so run down. You know, you get through it and then you collapse. Okay. I'm available tomorrow. I'm available on Saturday. I'm available on Sunday. Remember, if you're in California, please remember the time difference, okay? Call me if you have questions. Call me if you get into this and you're thinking, I don't know if I can do this on the test, because I will go over it with you. All right, and I'll post this video in the morning. Sound good? And I'm really sorry about not taking a break, especially for me, because I have to go do my husband's lunch. See, it's really all about me. All right, I will see you on Tuesday.
Thank you so
My
much.
daughter's birthday.
Thank you.
Thank you for coming. Have a good night.
You too.